all that is riding on tomorrow's CPI and what the various scenarios could mean for your money. Let's ask Lauren Goodwin of New York Life. She's with me here at Post 9. Welcome back. It's good to see you. So the Bears, you know their argument, right? It's don't fight the Fed. The Bulls are like, don't fight the tape. And the Dow just had its best day of February. You're near 20% off the low. Which side are you on? Don't fight the Fed, don't fight the tape.
I can't fight the Fed, Scott. I can't fight the Fed. And there's two reasons for that. The first, of course, is the obvious one, which is that interest rates are still moving higher. And while the bond market has gotten on board more or less with what the Fed is saying it will do over the past week or so, that's 2 more 25 basis point hikes and then a cut not until the later half of this year. I disagree with that second part, but we can talk about that later.
All right.
But the other reason I don't fight the Fed is that the Fed's policy is starting to work. And I'm seeing clear evidence that the economy is slowing. And that combination is not an environment where I see upside potential for earnings from here. And it's been a tough earnings season. So got to be in the bear camp.
But what's this rally then about? Why is the Dow, as I said, near 20% off of its low? Bond market has sort of moved more into alignment with where the Fed is. It's the stock market that some suggest is still delusional about where we are.
Yeah, and I'm in that delusional camp a little bit. The stocks are seeing a Fed pause window, a combination of relief from the Fed nearing the end of its hiking rally and hopes for a soft economic landing.
Isn't it near the end, though?
It is, but rates are still moving higher, and I think effectively stocks are struggling, as is typically the case with, again, two things. One is that it's always a soft landing until it isn't. Every recession over the last 60 years, we've had language around soft landing until the second half of economic dominoes started to topple, and we just haven't gotten there yet.
What happens if the CPI is good tomorrow?
You mean as if it
what happens if it's cool?
Moves lower?
Yeah.
Another, I think, great day or good momentum for that soft landing story, which is good for growth equity.
But at some point you have to put the puzzle pieces together and it amounts to a picture, right? I mean, at what point do you go as far as to say, you know what, I actually think that a soft landing or even no landing, as some are suggesting, is more likely, and I need to change my direction on stocks?
Yeah, so here's where I struggle with the soft landing story. This late cycle economic dynamic that we're sitting in, it's full of mixed data. Again, that's pretty typical. So you have some areas of the economy, the interest rate sensitive sectors like housing, manufacturing, already falling out of bed. But other areas like the consumer and services doing really well. Mm-hmm. Again, that's pretty typical. That's just a matter of timing as opposed to data really being mixed.
Okay, so you think that the consumer's going to roll over?
I do.
It's just a matter of time.
I do.
That's that leg of the stool that breaks and then the stool falls over.
That's right. The consumer has been so resilient. We've been hearing it from retailers all throughout this earnings season. Resilient from savings that have accumulated over time that have given the consumer a bolster, high wages as well. But we're seeing early signs of those sources of resilience fading. We're not getting more government support as the economy slows. We know that to be the case. Mm-hmm. And then things like the savings rate ticking higher and consumer credit moving higher as well, defaults moving higher. And so those early signs that consumers starting to have trouble to me suggest that domino, while we might have a couple more quarters before it totally topples, it's on its way.
Okay, so similar commentary from Morgan Stanley's Mike Wilson, right? He's been in the bear camp. He had a note out today that it's time to start positioning for the end of the bear market rally, right? So he thinks it's going to end soon. You might as well start positioning for it now. Do you agree with that too? In other words, if you look at what's run a lot to start the year, start to fade that as reality sets in, so to speak?
Yeah, I love it. Some of the sectors that we were talking about right at the beginning of the year before this rally really took off, things that were expensive, like defensive equity sectors, value equity, those are exactly the type of sectors that I'll be leaning into. In fact, I'm using the price action that we've seen over the past 6 weeks to take a little off the top of growthier long duration assets.
Okay.
And move it into even equity-like risk in bonds, high yield bonds as an example. So really trying to leverage some of the duration sensitive move up, move it into areas I think are more resilient.